If you could only own one stock for the rest of your life, which one would it be? A friend of mine asked me this question a couple of weeks ago, and at first I didn't have a concrete answer for him. In fact, at first I found the whole idea of only owning one stock very risky and stupid. I mean, one of the first things you learn in investing is not to put all your eggs in one basket. But then I started thinking, even if the answer itself doesn't matter, it would still be very valuable and interesting to see how we even get to the answer. And by the end of this video, you will learn not only which stock I would choose, which really doesn't matter, but more importantly, how I would approach such a question and the method of getting to an answer. My name is Florian, welcome to the channel. And for the record, I don't think that it's a good idea to only invest in one stock. I would never do that myself, and I would never recommend that to anybody else. But I still find the question a very interesting one, because I think in answering it, it will teach us some lessons to become a better investor. And for this experiment, no funds or ETFs are allowed for obvious reasons. So first and foremost, to identify the ideal forever stock, I considered how I would search for such a company. What key criteria would be most important? The absolute worst thing that could happen is that the company I invested in goes bankrupt and I lose all my money. So the most important criteria for our pick should be longevity. For example, I'm 39 years old and I'd assume that I'll get to be around 100 years old. That might sound really old, but it leaves me with a remaining investment time frame of around 60 years. In your case, it might even be a bit longer, so let's just assume that such an investment needs to survive for 60 to 80 years. Now, unfortunately, I can't look into the future to see how life looks in 80 years, but I would think that it will be quite different from today. How exactly? I have no clue. But exactly because we don't know how the future looks, and even 20 years is an incredibly long time frame in investing, we should choose a company that is operating in a sector that will for sure still be needed in the future. And from the 11 sectors that are defined in the Global Industry Classification Standard, or GICS, from MSCI and Standard & Poor's, I think that only 3 sectors fit this criteria. And these are the healthcare, consumer staple, and the utility sector. This already eliminates roughly 75% of all stocks and makes our choice much easier. And of course, if we only hold one stock for such a long time frame, it would be great to have a steady growth without much fluctuations. So we should at least try to reduce the individual risks of our company. This is also called the unsystematic risk, and when removed, still leaves the fluctuation of the stock price in total and the tendency for all stocks to go along with the general market, which is called systematic risk. In a regular portfolio, this is usually reduced by diversifying. Just take a look at this graph from one of my favorite books, A Random Walk Down Wall Street. Here we see that the unsystematic risk is reduced by including more securities, in our case stocks, to the portfolio. This reduction follows an asymptotic pattern, meaning that while the first few stocks significantly reduce the risk, the impact of adding additional stocks diminishes as the portfolio grows. But we can't add on any more stocks in our case. And no funds or ETFs are allowed. This would defy the whole purpose of this exercise. But what we can do instead is to choose an investment that is inherently diversified. If possible, even across different sectors. So, where can we find such a company? Well, we can find this in a conglomerate. A conglomerate is a large corporation, usually made up of diverse businesses that often even operate in different industries. These companies are typical multinational companies with multiple subsidiaries. One great example for a conglomerate would be Warren Buffett's Berkshire Hathaway. They are operating in many different, totally unrelated segments like insurance, utility, manufacturing, service and retail, and even real estate and media. The so-called conglomerate discount is a result of this diversification. But when we hold a stock for such a long time, this is rather a benefit than a disadvantage. Now, we already found out that our investment should be a conglomerate that is either operating in the healthcare, consumer staples, or utility sector. But that still leaves us with plenty of companies. So how can we narrow that down even further? For that, we need to look to the past to deduce the quality of a company and to see if they could not only survive, but also thrive in many different macroeconomic environments and to adapt their business model over many different technological levels. And of course, the newer the company is, the less established the track record and the higher the risks. So we need to look for companies with an established track record. And at the moment, there are a total of 55,000 listed companies worldwide. But only a couple of hundred of them could achieve the incredible feat of raising their dividends for more than 25 years. And there are even less companies that could top even this with more than 50 years of dividend increase. Just imagine for a second that you work at a company where you get a raise every single year for more than 50 years, regardless of the economic circumstances or your work performance. Sounds incredible, right? So let's see which Dividend Kings are operating in the 3 sectors that we choose and could fit our criteria. Here is the full list of Dividend Kings sorted by sectors. So we have already brought down the number of potential candidates for our investment from 55,000 to just 27 in just a couple of minutes. And from these 27, there are 3 that stand out to me. And these 3 are Johnson & Johnson from the healthcare sector, and Procter & Gamble and Colgate-Palmolive from the consumer staples. And while there are also some big companies in the utility sector that could count as conglomerates, I didn't choose any of them because they are usually focused on a relatively small geographic area. This increases the risk again compared to the more globally operating companies that made my top 3. And full disclosure, I didn't go through all the details of each company here. So my top 3 picks are a bit arbitrary. But remember, the pick itself doesn't matter either way. It's the way we select our stock that's important. What all 3 companies have in common though, and what led me to choose them, is that their business are diversified geographically as well as over several business segments. Here you can see this with the example from Procter & Gamble. But when choosing a forever stock, it is not enough to know that they are diversified and have a long and stable track record. Because even though dividend aristocrats have the reputation to be safe investments, it is not unheard of that even they sometimes fail. 2 examples for such fallen stars would be General Motors and Kodak. So we also need to make sure that, at least based on today's numbers, the company is as safe as possible. And the first metric I look at for safety in a dividend aristocrat is the payout ratio, or to be more specific, the cash flow payout ratio. This is the ratio of the total amount of dividend payments of a company based on their free cash flow. So a company with a very high payout ratio could maybe endure a bad year without cutting or suspending the dividend. But a company with a very low payout ratio has much more flexibility and safety in this regard. I am usually looking for a cash flow payout ratio below 50%, but this can be different based on the industry and maturity of the company. The second important metric for a forever stock is a dividend growth that should be higher than the inflation rate, but still sustainable over the long run. Because if this is the case, then our dividend will grow quicker than the money is losing its value. And last but not least, I also look at the balance sheet and the credit rating of a company. What I'm trying to find out here is the debt level of the company by checking the debt to EBITDA ratio and how safe rating agencies consider the company's ability to meet its financial obligations in time. A good starting point here would be an investment grade credit rating, which for long-term debt is considered to be BBB- or higher for Fitch and S&P Global, and Baa3 or higher for Moody's. So now let's apply what we just learned and see which of our 3 companies comes out on top. I usually use Tradingview and Seeking Alpha for my analysis, and because these are very basic metrics that we look at, we can find all of them except the credit rating in both tools easily. Let me show you my process in Tradingview, because I think that many people don't even know that you can not only use it for technical analysis, but also for fundamental one. Here in Tradingview, you can actually build your own layouts to visualize the data that you want to see. I find it easier to see trends when I have the data visualized and not only in table form. So, for example, I built several layouts to check different financial aspects. This one, for example, is to show some important aspects in the balance sheets. I am using the cheapest paid plan, the Essential plan for Tradingview, but as far as I know, you can also build these layouts with the free version, only with less charts displayed at the same time. And this is not a sponsored video. I am using these tools because from the many different tools I tried, I just find Tradingview and Seeking Alpha the best and most affordable ones. If you want to try out Tradingview for yourself and support the channel, there is an affiliate link down in the description. I'd recommend starting with the free plan to see how you like it, and if necessary, switch to the paid plan when you need it. So back to our balance sheet. In the top left corner you can see the charts for free cash flow in yellow, and below that the total common dividends the company paid in pink. So it is very easy to calculate the free cash flow payout ratio by just dividing the dividends paid with the free cash flow and multiplying the result with 100. And this gives us a dividend payout ratio of 65% for Procter & Gamble. The debt to EBITDA ratio is also easily calculated from here. I usually use the net long-term debt, so for this we first need to subtract the cash position from the long-term debt. So 38.1 minus 9.5 billion and then divide it by the EBITDA. 23. And this leaves us with a ratio of 1.23 times, which is a very nice and safe value. It basically means that the company could pay back all its debt within the next 5 quarters if they'd like to do that. To check the dividend growth rate, I usually use Seeking Alpha because they calculate the value for you. But let me also show you how it's done here. First, we need to check the dividends per share from the last 5 years, which is done under Financials and then Dividends. Here you have to check the value from the last fiscal year and, depending on the time frame you want to look at, the value at the start of your time frame. I am using 5 years, so I'll use the value from 2019, which was $2.90. Then you can plug this into your CAGR calculator. In my case, I use Excel. If you don't know how to do the calculation, there is a very easy RRI function that does it for you. You can just copy it from here. And for Procter & Gamble, that leaves us with a 5-year dividend CAGR of 5.7%. I haven't found a good source to check the credit ratings reliably yet, unfortunately. So if you have a good and easy solution, please let me know down in the comments. What I usually do is a quick search in the 10K or 10Q forms. And look at that. In case of Procter & Gamble, they have it right here. So they have a credit rating of S&P Global of AA-, which is quite good and definitely well within the investment grade range. And now that we know how to do it, let me just quickly do the same exercise for the remaining 2 companies so we can compare them properly. And here are the finished results. So Johnson & Johnson has the highest dividend growth rate, the lowest debt to EBITDA and the best credit rating from our 3 companies. That already looks very promising. Only the cash flow payout ratio is a bit high for my taste. But overall, they are the winner of our group and also this exercise. But let me say this again. I think it is quite stupid to only own one stock. The purpose of this exercise is to check for the most important qualities that such an investment should bring and how to apply it to actually screen for such a stock. And here you have it. You now have the knowledge to search for your own perfect forever stock. Unfortunately, many of such stocks that could be viewed as forever stocks are currently quite expensive. I believe that there are still very good and cheap small cap stocks out there that can help to boost the performance of our portfolios. Therefore, I just launched my new series Small Cap Sunday last week with a video of a very unique renewable energy company that I actually own myself and of which analysts believe that they can more than double their stock price in the next year alone. If this sounds interesting to you, you should check out this video. That being said, thank you so much for watching, guys, and see you in the next video.